This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do.
Getting defensive, the president-elect pits Lockheed Martin against Boeing, taking his negotiating approach to Twitter and thereby turning the defense industry upside down.
Surprise, surprise. It might sound crazy, but our market monitor says Wells Fargo is a stock to own despite its run of stumbles and scandals.
Striking it big, how one entrepreneur turned rundown bowling alleys into a modern powerhouse brand. Find out how he made his millions tonight on Nightly Business Report. It's Friday, December the 23rd. Good evening, everybody. I'm Bill Griffith in tonight for Tyler Matheson.
And I'm Sue Herrera. Thanks for joining us, everybody. The defense sector is being shaken up. The president-elect is pitting Lockheed Martin against Boeing, two of the world's biggest defense contractors. And today, Lockheed stock felt the pressure. As we reported last night, Donald Trump tweeted that he could use a Boeing plane as a substitute for Lockheed Martin's F-35 combat jet. The F-35 is the most expensive weapons system in history, with an estimated $400 billion price tag, nearly double the original budget. Morgan Brennan has more on what has the potential to be a big fight over fighter jets.
Call it a fighter jet face-off. Donald Trump is pitting the two biggest U.S. defense contractors against each other, taking to Twitter to do it. The president-elect lobbing his latest 140-character social media missile at Lockheed Martin again, writing, quote, based on the tremendous cost and cost overruns of the Lockheed Martin F-35, I have asked Boeing to price out a comparable F-18 Super Hornet. But can the fourth-generation Super Hornet actually compete with a fifth-generation F-35 Joint Strike Fighter? Short answer, no. It's not designed to be stealthy, and it doesn't have the advanced electronics. Two major factors that would take years and billions of dollars to become reality. And even then, say analysts, not likely. But it is a highly unusual move for a commander-in-chief, signaling a new era of competition.
Those companies doing the work will be very attuned to performance, and they will probably understand that they're not going to get a very sympathetic ear in the Pentagon or certainly from the Oval Office if there are front-page headlines about delays or cost overruns or things like that. The president-elect has shown a willingness to reach out 140 characters at a time and rattle company managements if they're doing something that he doesn't like.
The F-35 variants cost upwards of $100 million, though Lockheed says it is working to drive that down to $85 million by 2020. Its low radar signature means it can get closer to targets before it's actually in danger. But the less expensive FA-18s have already snagged some defense dollars that otherwise may have gone to its newer rivals. For the Navy, as well as Canada, which announced a Super Hornet deal last month. Of course, this could all be the president-elect's art of the deal, something he shed light on nearly a decade ago.
I say it ad nauseum. I'll tell people during the negotiation, you think you're the only one? I have 10 people that want this deal. And sometimes it's so, and sometimes it's a little bit less than so. But I always create competition because it makes the other side a little bit nervous. And even if I've had my own people come up to me and say, oh, Mr. Trump, you shouldn't keep telling them that there are other people. I said, do me a favor, let me negotiate. I want to drum them. I want to brainwash them. I want to think that there is so much competition.
And creating competition is the goal, especially as Lockheed negotiates more F-35 contracts, and does so on the heels of an unprecedented contract in which the Pentagon unilaterally decided the price it was willing to pay. For a Nightly Business Report, I'm Morgan Brennan.
Well, meanwhile, the president of Russia is rattling his own sabre on missile defense systems and nuclear weapons. During his annual end-of-year news conference, Vladimir Putin boasted about the strength of Russia's nuclear arsenal, but he did say he would not be drawn into an arms race with the U.S. His comments came after Donald Trump said the U.S. should expand its own nuclear capabilities. Eamon Javers is in Washington for us tonight. And Eamon, Russia spent about $50 billion on defense last year. So What else did he say on this very expensive topic?
Well, Vladimir Putin wasn't shy about talking about that, and particularly about talking about all the modernization that they have done in Russia of their nuclear forces. He also said that if there is a new arms race, which everyone's been talking about here over the past 24 hours or so, he said if that is so, it's certainly not Russia's fault. He pointed to the fact that the United States has been modernizing its nuclear forces and repositioning some of them as well, said that Russia is fully aware of that. And interestingly, given the history of the fall of the Soviet Union and the huge spending that they did in Russia in the 1980s, on weapons systems, he said to his domestic audience, we are going to be careful. If we are in a new arms race, we are not going to overspend here. We're not going to spend more than what we can afford. So he's reassuring the domestic audience as well that history won't repeat itself the way we saw it in the 1980s.
Did he talk at all about the sanctions and their impact that they might be having on the Russian people and the Russian economy?
Well, clearly what Vladimir Putin doesn't want to say is that the sanctions are having a very harsh effect on the Russian economy. It's very tough on some of the oligarchs there who are close to Vladimir Putin. They were designed by the Obama administration to be that way and to be sort of an economic pincer there. That's a problem for Vladimir Putin, and I think that as we pivot to 2017, what you're going to see is that Vladimir Putin really, really, really wants to get those sanctions repealed. We'll see whether Donald Trump agrees with that or has something else in mind.
Eamon Javers in Washington, as always. Thanks.
You bet.
We have been reporting on China's reaction to the president-elect's choice of Peter Navarro to head a new White House National Trade Council. Navarro is a vocal critic of the world's second-largest economy. Today, Chinese state media expressed alarm and warned of a slowdown with the U.S. Quote, that individuals such as Navarro, who have a bias against China, are being picked to work in leading positions in the next administration is no laughing matter, end quote.
So with tensions rising with China and the chatter of an arms race, new uncertainties are being introduced right now, something that the market typically doesn't like. So what should investors make of all of this? Joining us tonight is Paul Christopher, head of global market strategist at Wells Fargo Investment Institute. Paul, good to see you.
Thank you very much.
Here we sit with the U.S. markets near all-time highs, so clearly they're not too bothered about right now, but I guess we do have to take a wait-and-see attitude to see how this all plays out during the new administration, don't we?
That's right. With the tweeter-in-chief in the wings, there are just so many different possibilities for foreign policy and trade policy. We think investors are best off right now sticking with their investment plans.
What are you most worried about? I mean, we see the relationship between Mr. Trump and Mr. Putin, but now we see China kind of coming on the offensive, saying, you know, kind of a shot across the U.S. bow. What are you watching the most closely?
That's right. I think your reporter hit the nail on the head a few minutes ago in the segment where you mentioned the art of the deal. Mr. Trump, President-elect Trump, has his own art of the deal. So I think does Vladimir Putin. And so does the president, the Chinese leadership. They have their own art of the deal, and the stakes are very, very great. They're very large, and we don't really know how things will play out if each side starts taking on a different style of negotiation. So, yeah, we're worried about how China reacts or negotiates with the U.S. We're worried about the U.S. in the Middle East and how the new foreign policy may change the balance of power there,
right.
And, of course, in Eastern Europe.
You know, Wilbur Ross, who, of course, is the Commerce Department head-elect, has said that for him, tariffs are a last resort. Yet Mr. Trump continues to mention them in the first sentence when he's talking about trade relations with other countries. What do you think tariffs would do to our economy, to the companies that have to export overseas and import goods here? And what would that do to the stock market?
Yeah, the first thing to realize is that it's not really just a multinationals problem anymore. All sorts of U.S. domestic companies, small cap, mid cap companies have global or globalized supply chains now, even cutting off trade or reducing trade with Mexico by threatening to renegotiate NAFTA. That could be difficult for a lot of U.S. companies, a broad swath of U.S. companies. And so we think that would be negative for equities. We think it would boost inflation, push up bond yields, and it would be a source of some frustration and uncertainty for earnings going forward.
But again, we have to all wait and see how it all plays out in 2017. Paul Christopher with Wells Fargo Investment Institute. Thanks again tonight.
Thanks.
On Wall Street, a rise in new home sales and an increase in consumer sentiment were not enough to give stocks a big lift. Equities meandered all session ahead of the Christmas holiday. The Dow finished up about 15 points to 19,933. The Nasdaq added 15, and the S&P 500 gained 2. For the week, there was a bit of holiday cheer for the three major indexes.
The Obama administration has struck deals with both Deutsche Bank and with Credit Suisse over toxic securities. Deutsche Bank has agreed to pay more than $7 billion to settle with the Justice Department over its sales of risky mortgage-backed securities, which contributed to the financial crisis. Separately, Credit Suisse has agreed to pay more than $5 billion to settle the probe into its sales of subprime mortgage bonds.
The Justice Department took the unusual step of suing Barclays over its toxic mortgage-backed securities instead of settling. The government alleges that the bank fraudulently sold more than $30 billion of those risky bonds. The lawsuit comes after talks to reach a settlement broke down.
Certainly, retailers are hoping that the Grinch doesn't steal Christmas this year, with most making a last-minute push, very last minute, to lure shoppers in. It's an important time of year for the sector because many of the stores earn the bulk of their revenue right now in the fourth quarter. Courtney Reagan reports for us tonight from the Queens Center Mall in Elmhurst, New York.
If you haven't finished your holiday shopping yet, you're not alone.
Today's my first day.
There's going to be last-minute shopping.
During the season, millions of Americans turn to the internet to check off their shopping list, pushing online sales up nearly 11%, according to Adobe.
I've done it online.
When you go to specific sales and then you look online, you can find a difference.
But the clock has run out on standard shipping in time for Christmas. With Christmas less than 2 days away, many stores are very busy today, at least compared to other days so far this holiday season. With Christmas Eve and Hanukkah tomorrow, it's pretty much traditional retailers' last chance to scoop up those sales. ShopperTrack, which tracks in-store foot traffic, expects today will turn out to be the third biggest day of the year for shopper visits. Retailers' Christmas wish is for that forecast to translate into strong sales in the final hours.
I'm getting something for my mother. I'm getting something from Pink for my girlfriend.
I have a little trinket for a Secret Santa at the office. Something for the kids and for the lady.
Sales tracking data from NPD through December 10th shows the typical shopping lull between Black Friday and 2 weeks before Christmas, a drop-off that's become an unwelcome tradition, has been deeper this year than usual.
The trend this year has been one of hopeful expectation that has not materialized for most retailers. So there was a real hope that last weekend and into this week there would be a surge of shoppers in the brick and mortar stores, and we just simply haven't seen that.
Bynes thinks in-store shopping hasn't been great so far, partly due to the strength of online shopping, but also because retailers have trained shoppers the longer they wait, the deeper the discounts get. He joins the chorus of others expecting holiday sales to still grow the forecasted 3 to 4% this season, though Bynes points out that means only an average season. But there's always a chance for a Christmas miracle. For Nightly Business Report, I'm Courtney Reagan in Elmhurst, New York.
Still ahead, why Hollywood is not celebrating what has been a record year at the box office. So Hollywood is on pace for another record year, but the entertainment industry is not celebrating the milestone. Julia Borston explains why.
The North American box office will hit a new record this year, topping $11.3 billion, according to ComScore. But hidden in that record are some concerning trends. Higher ticket prices are driving the record box office haul, not bigger audiences. Attendance is expected to be flat from 2015, but down about 6% from a decade ago.
When you look at the percentage increases over the years in box office revenues, often that comes a little bit at the expense of attendance because of those higher ticket prices.
Thanks to declining home entertainment revenue, high marketing costs, and fewer big hits, average profits of the 7 biggest studios fell 17% through September, according to Cowen.
I remember my family!
And Disney dominated, earning more than half of industry profits in that period, with 5 of the 10 biggest films of the year, including the top 2, Finding Dory and Captain America: Civil War. All the studios, though, suffered from some high-budget flops. From Paramount's Ben-Hur to Disney's BFG to Lionsgate's The Divergent series Allegiant. Another sign of cracks in the system, only 3 of 14 summer sequels outperformed their predecessors, with familiar names such as Zoolander 2 and Bridget Jones falling flat. And while China's box office grew by almost half last year, boosting Hollywood revenue, this year Chinese growth basically flatlined. ComScore's Paul DeGarabedian says expecting China's box office growth to continue would be misguided.
It has gone from a novelty-driven factor where audiences there haven't really had those kind of in-theater experiences with the great amenities and these brand new beautiful theaters. Now that will shift from a novelty factor for the movie-going experience and shift to the quality of the movies.
With so many entertainment alternatives both in the U.S. and abroad, and the cost of going to theaters on the rise, the bar for quality content is higher than ever. For Nightly Business Report, I'm Julia Borston in San Francisco.
China hits General Motors with a $29 million fine, and that's where we begin tonight's market focus. Chinese officials allege that the automaker's joint venture engaged in monopolistic pricing for Buick, Cadillac, and Chevrolet models. GM says it will ensure all appropriate actions are taken in regards to this matter. It doesn't happen often, but GM shares managed to finish the day right where they began, unchanged at $35.69. Discount store operator Fred's saw its shares rise today after a regulatory filing revealed Alden Global Capital took a nearly 25% stake in the company. The activist investor says the shares are undervalued and represent an attractive investment opportunity. Shares finished the day up 4% to $20.20. And Cal-Maine Foods swung to a quarterly loss. The egg producer said it was negatively impacted by an oversupply of eggs, but that prices has started to increase recently. Shares rose 7% to $44.95.
Shares of GNC Holdings hit a record low today after Piper Jaffray cut its rating on that stock to underweight and slashed its price target. The analyst said that the company's decision to discontinue its paid membership program adds to the risk of an earnings miss. And as a result, the stock was down 10% today to $10.84. Medical supplies distributor Cardinal Health will pay $10 million to the U.S. government. Regulators allege that the company failed to report suspiciously large orders of addictive painkillers. Cardinal Health shares rose, though, to $72.88.
And now to our market monitor, who has names of large cap stocks he says could benefit from the Trump presidency. This is his first time joining us on the program. He's Damon Barglow, portfolio manager at Rockland Trust Investment Management Group. Welcome, Damon. Nice to have you here.
Hello. Thanks for having me.
Let's start with your first pick. We're going to get right to them. ExxonMobil. It probably is pretty obvious one of the reasons why you like it, but tell us more.
Yeah, I mean, clearly the fact that Tillerson's going to be Secretary of State and Exxon has a friend on Capitol Hill, that can only help them, right? But mainly the reason why we like them is energy stocks have come up quite a bit off of their 2015 lows, but we think there's still room to run, particularly when OPEC is talking about production cuts, and then the incoming administration is talking about deregulation that could benefit production and exploration.
Another of your picks, Home Depot. It rises and falls along with the fortunes of the housing market. I guess you're betting on a better housing market down the road, huh?
Yeah, well, actually, the housing market is pretty good right now. We've had, pretty good increases in home equity value over time, but Home Depot is a direct beneficiary of those rises in terms of home equity value, because then people are going to do repairs and remodeling. The other thing is, if you think about a reduction in corporate taxes, Home Depot gets 90% of their sales from the United States versus the average of about 50% for most large cap companies in the S&P. And then clearly Trump has made home ownership a key initiative of his administration. And we got these great numbers today in terms of increased home sales. But if he can do anything to help that, that would be a positive for Home Depot.
I'm curious about your last pick, which is Wells Fargo, because the bank has had such tough sledding. There are still investigations pending. The California Attorney General looking in at possible criminal activity. Why do you like the stock at this juncture?
Well, we like it in part for those reasons. It's a little bit tarnished, and we're not afraid to go after a company that has a little scandal associated with it. the fact is that the key players that were part of the cross-selling scandal are out, Stumpf and their head of community banking, Tolstat. And I really believe that they can do well along with their other big banking peers. If you think about the Trump bump post-election, a lot of their big peers, they rallied along with their peers, but they're still lagging them significantly. And so I think if you want to take advantage of a favorable environment for banking, it's not too late with Wells Fargo.
On that note, Damon, thank you very much for joining us. Damon
Thank you.
Barglow with Rockland Trust Investment Management Group. Coming up, meet the entrepreneur who put a new spin on an age-old sport and turned it into a successful empire. Find out how he made his millions next.
More than 67 million people bowled at least one time last year, more than a third of them at a place run by Tom Shannon. He's an entrepreneur who has turned rundown alleys into an international brand that has become the largest player in the $6 billion U.S. bowling industry. Tyler Matheson introduces us to him in tonight's How I Made My Millions.
I haven't got a chance. Well, maybe I do.
Don't let that first ball fool you.
That was pretty abysmal.
Tom Shannon knows how to strike it rich in bowling.
How many total bowling centers do you run?
Now 308 and about 9,000 employees.
His 10-pin empire, known broadly as Bowlmore AMF, racks up about $550 million in annual revenue and hosts plenty of celebrities.
Al Pacino, the Kardashians.
The Kardashians were here? You're kidding me.
I taught Kim how to bowl.
I bet you did.
It all started with a lot less glamour and a single location, Bowlmore Lanes, a New York City institution that Shannon walked into in 1994, more than a half a century after it opened.
It was very run down, probably no investment in it in at least 3 decades.
But the Darden Business School graduates saw potential for a revamped bowling experience.
Business was financed with a combination of $3,000 in equity, which is all I had, and $2 million borrowed.
From whom?
About 2/3 of it was a seller note. I borrowed money from SBICs, Small Business Investment Corps, at 17.5% interest.
Then he went to work, adding new technology, updating the decor, improving the music and the menu, and transforming the tired bowling alley into a hip nighttime destination.
We used to renovate during the day, clean up, and open for business at 5 o'clock.
And it worked. Shannon says by 1999, the Union Square location was the highest grossing bowling alley in the country. 2 years later, he tried the same trick in suburban Maryland with a similar result.
And so I thought, well, if it's working in Manhattan and it's working in Bethesda, we have a model that'll work.
Soon he saw customers rolling through the doors of 6 Bowlmore centers at a time when thousands of alleys were closing shop, including AMF, the biggest player in bowling at the time. For Shannon, it was an entry angle to big league bowling.
I partnered up with a private equity firm, and we managed to buy AMF out of bankruptcy for $300 million. So overnight, I went from 6 bowling alleys to 272.
Then there's another acquisition. You get even bigger, Brunswick.
Yes, so this was, I would have to say, a little bit audacious.
The newly combined Bowlmore AMF spent $270 million to score 85 additional centers from Brunswick in 2014. The company currently operates under 4 brand names: Bowlmore, AMF, Brunswick Zone, and Bolero, and it spares no expense on renovations.
Do you work with like theatrical stage and set designers to do this?
We do it all in-house. For me, maybe the funnest part of the business is that I get to create this crazy spectacle in which you can bowl, and it actually has an economic return.
A healthy one at that. In 2015, the annual revenue hit higher than $500 million and welcomed more than 25 million visitors to its lanes.
I view this as a long-term play, and I don't know where the limit is. I expect at some point we'll be a multi-billion-dollar diversified entertainment company.
Yes!
Well done.
Good for you, Tyler. And I know what you're thinking. Shannon has no plans to take this company public anytime soon, but he is looking to expand his empire outside the bowling industry. Stay tuned.
And finally tonight, consumers are joyful, at least according to the latest data on Christmas tree sales. Purchases are up 10% from a year ago, and the assumption is that if trees are selling briskly, consumers may also increase their spending on gifts. And as the theory goes, if spending increases, the broader economy will benefit. Makes sense to me.
It does. You done with the wrapping?
No. I'm not done. I'm done with the buying.
Tick-tock.
I know. No kidding.
All right.
That'll do it for Nightly Business Report for tonight. I'm Sue Herrera. Have a great holiday, everybody.
I'm Bill Griffith. Merry Christmas. Happy Hanukkah. We will see you Monday for a special edition of NBR. Good night.
Nightly Business Report has been funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do